investing in property makes sense. Investing in the right property takes knowledge. Welcome to the Rewarding Property Decisions podcast. I'm Jared McCabe, Director of Wakeland Property Advisory. Join me for expert insights into the fundamentals, trends and opportunities to help you create long-term wealth through smart property decisions. Hi everyone, and welcome to episode 25 of the Rewarding Property Decisions podcast. So I'm quite excited today. I mentioned last year that this year we would be looking to try and have a few more guests involved with the podcast. So I've got my first guest for the year, Jordan Telfer, who's a long-time colleague and a good friend of mine. Jordan's got a long history with Wakeland Property Advisory, having commenced work with us, or with the company with Richard, Monique and Paul back in early 2000. And having a bit of a change in 2006 and going into valuations for 8 years or so, and then coming back to us in 2014. So many of you who are actually Wakeland Property Advisory clients will probably know Jordan. He oversees the property managers that we work with on a day-to-day basis, but he also carries out many of the portfolio reviews for existing clients. So welcome to the podcast, Jordan.
Thanks, Jared.
All right, so Jordan and I and Brent and Potter, as well as other team members, for a long time now, obviously, are regularly discussing the apartment market, and it's a strong topic that we discuss amongst ourselves, but also with clients on a fairly regular basis. We've always wanting to assist where we can, look at how the apartment market has been performing, perhaps why it hasn't performed as well in recent times as we may have liked it to, and what are some of the things that perhaps we can do as advisors, but also suggest to those that do own apartments to do to the properties to improve performance from both a rental but also from a growth perspective. So there's quite a bit to talk about. So what Jordan and I have decided to do is break it into three parts. So this will be a three-part podcast, looking at firstly the state of the market. Then the next podcast will cover off on overcapitalised versus undercapitalised property, and then how and where you can add value to an apartment, and what are the best ways to do that. So as I said before, the apartment market in recent times certainly probably hasn't performed or had the growth that the housing sector has had, particularly over the past 7 to 8 years. Now, for those of you that are familiar with the podcast, usually I like to go through all the content and then at the end discuss a story or a case study. But in order to set up the framework today, I'm going to hand over to Jordan, and he's going to go over a couple of case studies just looking at the apartment market versus the housing market over an extended period of time and how that relates. And then we'll discuss going forward the performance of the apartment market and expectations going forward as well. So Jordan, do you want to give us a bit of a rundown here?
Sure. I thought it best to approach this by looking at probably the historical, not only performance of the apartment market, but how has the apartment market in Melbourne developed, particularly over the last 20 to 25 years. And I suppose we look at certain key periods in the development of Melbourne's inner city, inner suburbs. And we probably can go back to, say, 1990s, which is when post-recession there was a concerted effort on the government to revitalise the CBD through Postcode 3000, and that kicked off significant residential apartment development centred around particularly the CBD, but also what was then a fairly new suburb, if you like, in South Bank. So that's the typical high-rises that we're all pretty familiar with now as we cut through the city. That continued on pretty much right throughout the 90s, 2000 to 2010, then Docklands came on board as a totally new suburb. And again, most of us are familiar with the continuing development of that precinct of Melbourne. To that point, apartment development was concentrated in those core CBD and city fringe suburbs, like, as I said, Docklands and South Bank. From 2010, though, we started to see the creep of the apartment development, the high density particularly is what I'm referring to.
Started to move into those inner city suburbs then, didn't it?
Yeah, the traditional inner city suburbs, so South Yarra, Hawthorn, for instance. A lot of us will be familiar with those high-rises behind South Yarra Station, between there and the river around Melbourne High, which has added a considerable amount of property to that sector of Melbourne.
We had a former colleague who took some pretty impressive photos from comparing a high-rise apartment that he'd looked at for an owner-occupier client on St Kilda Road and he looked at that apartment coincidentally back in and around 2010, took a photo of South Yarra looking back to the east, and then went and looked at coincidentally that same apartment 10 years later and took the same photo. And the difference of the South Yarra skyline over that period is amazing.
It was like a mini CBD.
Yeah.
It was extraordinary, wasn't it? So then from 2010 to now, we probably see a different emphasis, and that is a further creeping out of the high density apartment development into areas that were probably unthinkable 10 to 20 years ago. So middle ring suburbs like Box Hill, for instance, there's high rises in Box Hill. Who would have thought that 20 years ago? We just didn't perceive the demand to be there for the very reason that people wanted that part of the world for the
larger blocks of land and family home type scenarios. Yeah,
exactly. So it's been interesting, but it's also created certain definitely price pressures, particularly over the last 7 to 8 years, on those suburbs, on the developments, the more traditional developments from the 30s through to the 70s that were located in those core inner suburbs. So, so
let's have a look at this case study that you've put together on some apartments and a house. An apartment in South Yarra in a street that we've bought in many times over the years, Rockley Road, versus a house that is in Princess Street in Flemington, that again has sold a number of occasions over the last 20 years. So I found it really interesting in terms of how it painted the picture of growth over that period of time and when they started to diverge from one another.
Yeah, because anecdotally, I always I was under the impression and the view that from the early 2000s, when we were advising clients with a certain budget, there was a toss-up between, well, do we buy a really, really good quality apartment, big apartment, say in Rockley Road, South Yarra, or in an emerging housing market like Flemington or Kensington or Brunswick? And they were just about on par. The decision was one way or the other. There might have been an unrenovated house, but you get the land, or a renovated or large apartment with certain attributes and features that were quite rare in the market, but you don't get the land, but in a higher land value area. So it was a bit of a toss-up. So I went back and had a look at it, and there's a particular block that we all like in Rockley Road. It's probably one of the best blocks in that street, and compared that, as Jared says, to a house that sold at around about the same time in 2001. This apartment, 2 bedrooms, 1.5 bathrooms, dining area, lounge, sold for $337 in April 2001. 6 weeks before that, a house, 3 bedrooms, it's had an upstairs extension on it, sold for $340,000, and that was March 2001, so just about on parity. That house in Flemington sold subsequently in 2015 for $881,500, and around about the same time, in June 2015, that apartment sold for $830,000. So a little bit of a growth gap, but not significant, particularly when you consider the holding costs and the extra maintenance costs that are always expected with a house, and the extra expenses, land tax, all the rest of it has to be factored in. So pretty much on a par. And that was the experience up to about 2015. Really good quality 2-bedroom apartments versus entry-level houses. Not a lot of difference. So over the last 7 to 8 years, we've seen things diverge, and in some cases quite significantly. That apartment in Rockley Road sold in 2020, just on the on COVID.
Eve of COVID, it was around March.
It was. That sold for $905,000. So its previous sale 5 years, as I said, 5 years previously was $830,000. So it's put on ostensibly $75,000. There was some money put into this property to convert the 1.5 into a genuine 2-bedroom. I think it was a very, very good renovation, but it certainly would have cost. So that has to be factored in. The Flemington house hasn't undertaken any significant renovations. Now, there hasn't been a sale since on that Princess Street Flemington since the 2015, but looking at comparable sales, we would estimate that it should be in that current condition around about 1.2, perhaps 1.25.
And the apartment, given that there's been a couple of bigger sales in Rockley, Kensington Road in the last few years, It's been as high as 1.1. This one's probably not quite at that level, but it's probably close to circle around $1 million. So we're looking now at sort of 200, 250 in terms of the gap between the two.
And it's starting to grow, which is reasonably significant. It's 20-25% gap. Now, that is one of the best apartments in Rockley Road. This particular house is a good house, but it has its certain compromises in terms of its location within what is a reasonable street. So it probably doesn't. It probably isn't at the same sort of value as others in that part of the world, but there's still a noticeable growth gap. So that sort of backs up what our anecdotal experience was in terms of.
Okay, so let's have a look then at why this might have been the case. So we've got evidence to see that it starts to show that around the sort of 2015 mark seems to be when the apartment market started to slow up and not having the growth. And again, I just need to emphasise when we talk about apartments from our perspective, we're talking about the older style established. And if we're looking at things off the plan, you'd be extremely happy if you've bought something off the plan during any window over the last 10 to 12 years if it's actually retained its value. Majority of them off the plan, particularly in the entry level 1 and 2 bedrooms, reduce in value over that period of time. Yeah. So we're still focusing on the older style boutique blocks, 20 or less apartments, no lift, pool, gym, that type of thing, typically built between, say, 1930s Art Deco era through to about the 1960s, 70s. That's the type of property. So coming back to that, part of that, obviously, and we've got some graphic evidence which we'll include within the blog, so you can have a look at that there, around the amount of construction of apartments that, it started, as you said earlier, Jordan, in the 1990s, but it really started to take off through the sort of around the 2014, 15, 16 type time frame. There was quite a bit of construction that really started to occur in those inner city areas as opposed to the high-rise type developments, because prior to that there'd been a real distinction between high-rise apartments, CBD, Docklands, South Bank, versus boutique smaller blocks in the inner city areas, or inner city suburbs, I should say. So there's some pretty stark graphs. Now, the interesting thing there is that in the last 2 to 3 years, and some would say that it's partly to do with COVID, but there was certainly starting to be a decline prior to COVID kicking in the amount of construction of modern apartments being built in and around Melbourne as a whole. So that started to hold back. What have we seen in the rental market from that point of view? Obviously, again, during COVID, with the lack of migration and students, that type of thing coming in, there was certainly the vacancy rates really pushed out, but that seems to have changed in the last few months.
It has. The property managers that we work closely with are of the same mind in that the vacancy rates are certainly pulled right back. Now, that could be cyclical. The first quarter of the year tends to be the best time for an owner of a property to be finding a tenant. So we'll see if that continues throughout the rest of the year.
It is cyclical, I guess, but we weren't seeing that this time last year.
No, exactly.
When you would have expected that would have started to occur, and at the start of last year that still wasn't happening. So you'd like to, and particularly given that international borders and things are starting to open up, we are seeing more people come to visit. There's far more flexibility there. That it is heading in the right direction.
Yeah, and a lot of that in a city, if you like, rather than in a suburban stock, is starting to be quietly mopped up by those that are coming back into the country, be they students, be they people on working visas. That's quietly had a pretty profound impact on vacancy rates. There's signs that rents are certainly stabilising, if not increasing in certain sectors in the apartment market, which is very welcomed after a significant drop over COVID, for anywhere between 10 to 20% off baseline levels for these apartments. So that's very much welcomed.
What have we found in the past in terms of when the rental market does start to recover in the apartment sector? How does that flow on to capital values, that sort of thing?
Traditionally, what that has done is brought the attention of investors. They can see that, understandably, investors have been gun-shy over the last few years. First of all, after the effects brought about by the Banking Royal Commission turned the screws a little bit on investor lending, and understandably, investors were on the sidelines over the last couple of years if they weren't confident, particularly over COVID, that there would actually be a rental market. for their new purchase. So it was being driven by owner occupiers, particularly first home buyers, that sector of the market. So we would expect to see vacancy rates pull back, rents start to increase, and confidence starts to increase with the investor market. I think also there's a school of thought to say that actually apartments are fairly undervalued. When you look at this historically, well, it's probably the greatest gap between the median value of an apartment.
It is.
Compared to what the median value of a house is.
Yep.
There was some figures released earlier in the year based on December 2021, and we were looking at about an 86% gap between the median values of those two types of property. Compare that to 20 years previously, in 2001, it was only 17%. So there's a massive gap between the two. Now, that says, well, I could say one of two things. First of all, houses are extremely overvalued and are due for a fall, or historically speaking, apartments are very much undervalued.
Yeah.
And there should be a push on price.
And coming back to the investor side of things, which you mentioned just then as well, I mean, the other thing to factor in too there is around that time when we did start to see that apartment performance start to slow around the 2015 mark. Not long after that, we had the Royal Commission and things kick in on lending, and so it became quite difficult during that period for investors to be able to borrow funds. Yeah. So that also probably pulled them back and had them withdraw from the market to a certain extent as well. And there's been some talk of that being eased a little bit. Whether that does occur, that was meant to happen, I think, last year, but there was some changes there, so still being worked through. But obviously, interest rates are at record lows. Now, the talk at the moment is that the next movement is likely to be up. It'll be later this year, maybe next year, depending upon what continues to happen with inflation. But even if it does start to move, they're still extremely low. So if investors can start to have the confidence in that rental market and that there is demand for that type of property, and once, I think the other thing that is occurring at the moment, and obviously the pandemic was certainly not predicted or expected, but there's still occupants of those that were prepared and enjoyed living in apartments. There's still a hesitation around the fact that there's a concern that, well, what happens if I get locked up for 23 hours a day in an apartment again? And I think until we see an extended period of perhaps as much as 12 months or more where lockdowns are no longer the case, once we see that, I think that'll give tenants and buyers of apartments far more confidence that I can go back to living the way that I was and enjoying that cosmopolitan lifestyle that Melbourne's so famous for. And that will bring people back to do that sort of thing and have more confidence in the apartment market, both from a rental but also from a purchasing perspective.
Yep. Yeah, for sure.
All right. Well, was there anything else that you wanted to address?
Yeah, there was. One last thing that we've been noticing over the last 18 months or so, again, a little bit unexpected, is I wouldn't say a trend at this point, but we're seeing that what's now emerging is developers actually purchasing in premium suburbs of Melbourne. So those like Toorak, South Yarra, so where the land value is at its highest. It's very interesting that they're now being able to do their numbers and the purchase of whole blocks now.
The land value is really starting to push.
Yeah.
And it's really, it's not just, I mean, it's obviously, as you said, it starts in the absolute prestige suburbs. So it starts where the land value is hard. Lands are hard to come by. So you can't get access to it easily, but is also a prestigious area. And from a developer's point of view, they can construct a fairly prestigious product on the other end, and the demand will be there for it.
Yeah, which is interesting, because even just a few years ago, you would think that would not make any economic sense for a developer.
Yeah.
We've seen one particular block, one of actually 24 apartments in a...
So it's not a small block.
Not a small block.
Which is tend to be always the perception. No one will ever want to buy 25 apartments, 24 apartments. They'll only ever want to buy 4 or 6.
Yeah. Yeah, you'd expect that trend would emerge or start in perhaps the older style, we're very much older style Art Deco, which tended to be built back in the 30s and 40s, small 4 to 6 units, but on big blocks of land.
Yeah.
That's ripe for redevelopment.
Undercapitalised. Yeah.
But in this particular street in the Botanic Gardens precinct of Melbourne, I'm very surprised to see about 6 months, a year ago, this block of 24 1970s apartments, 3 levels of 8, was actually sold to a developer who presumably has in mind
so it's not like, say,
realising the land value.
10 years ago where a block might be sold like that and it was typically being sold to stick in a self-managed super fund and just continue to let the land appreciate or accumulate values. But really now this mindset is, okay, I'm going to buy that as a whole, but I'm actually going to now start to do something to maximise the land value of that product. And then whether or not there's an opportunity because of an existing use right to construct something else on the site and use that, well, obviously that's what developers work through with planning departments and things.
Yeah, and what's being replaced is not more of the same.
No.
It's, as you said, it's a much lower density.
Yeah.
The developers can buy the land for a certain amount and develop a product that appeals to
it's that owner-occupied penthouse type. So
it
might be only 3 stories, basement car park, lift access, but really premium type product. It's absolutely pitched at an owner-occupier and predominantly downsizes or town-based, that sort of thing.
Yeah. And so that's taking 24 apartments off the market and replacing it with a totally different product of maybe 4.
Yeah.
So this isn't widespread, but it's
starting.
It's starting.
Yeah.
We've seen enough of this over the last year to 2 years.
I reckon we've probably come close to seeing half a dozen in different forms, in different locations, on different size blocks. But it's not what it was. We used to see that still at a similar rate, but it was always for someone to just land bank basically and hold as a long-term investment, and it would grow well. But the intent now is more to redevelop these sites rather than just hold them.
So that could be. That's another interesting way that owners of these apartments that perhaps haven't seen the capital growth that would have been expected, particularly if they bought 10 years ago. The capital growth that they have achieved was probably in that first 2 or 3 years of ownership, and then it's, in a lot of cases, flatlined. But the land value is continuing to appreciate, and it's only when a developer comes knocking on the door of the owners that it can be realised.
And we're seeing too with these values that the sum of the parts is not, if you look at them on an individual basis, and you were to sell it individually, the price that's being paid for this as a whole is much higher than what the individual apartment would be worth.
It is, which makes sense too, because to shoehorn somebody out of their property, particularly if they're an owner-occupier, you need to give them a compelling reason to do so.
Yeah, absolutely.
And we've seen some significant premiums paid to the individual owners over and above what they could have expected had they gone to the local estate agent and sold in the usual manner.
By themselves. Yeah, absolutely.
So that's something to keep an eye on over the next couple of years.
Yeah, absolutely. All right, well, that's great. Thank you very much, Jordan. As I said, we will be putting out 2 further podcasts in this series regarding the apartment market. So keep an eye out for those. But as per usual, thanks for joining us for episode 25 of the Rewarding Property Decisions podcast. As always, please share the podcast widely and give us some high ratings on Apple and whatever platform you are listening to us on. And if you'd like further information on how to make rewarding property decisions, please visit our website, wakeland.com.au, and we wish you all the best with your property decisions.